There was one comment that came up. So nice of you to make James a shirt from your curtains. Now, I think this was so unfair.
We're going to talk about the difference between an investment bond and just investing in a company for kids' education.
Investment bonds are essentially you're paying the same tax rate as you are in a company. You could perceivably just invest the money in a company and then pay it out to your children as a fully franked dividend once they're an adult to help pay for their education in the future.
Yeah, I think you've said that well. It's easy, man. I'm just complimenting you the whole time. Buddy. You can get into this easy.
Yeah, I think it started with me commenting on your shirt and then you...
Yeah, I know. Yeah, I think that's rattled me, mate. I've lost the plot today. Hello, everyone. Welcome back to the Australian Retirement Podcast, your source of warm, fuzzy financial goodness, coming to your ears every Thursday. As always, I'm joined by my good friend, Drew Meredith. Hello, mate. Happy Thursday.
And that's why you're the better host, because your intro is always so much better and so much happier and full of energy. I feel it sounds like it's a chore, I think, when I'm doing it, but things are great. A little bit of sun. It's been enjoyable. And it's like nothing ever stops happening in markets or in government or in tax law or in anything at the moment. So it's been a busy few weeks.
Now, it'd be remiss of you not to share with everyone that amongst all of this chaos, you're currently enjoying a little. It's not a break, but you're over in Freo. Is that right?
Not quite yet. At the illustrious Crown Resorts at the moment. It's quite a good place to stay and hold meetings when we're in Perth. But catching up with prospects and existing clients for a bit of work and a bit of leisure as well over the weekend. So. I can't complain. It's like 17 degrees, sunny and beautiful out here. I think Perth.
At 9 a.m.
Someone was saying it's like a forgotten destination. I think like half the country forgets how nice Perth is. It's so flat. I know you like exercising, you like running, riding. It's incredibly flat, which you kind of forget, and huge. Like in Melbourne, we build on top of each other. In Perth, it's like everything's spread out. There's like every block is like 400 meters long.
Yeah.
It's fantastic.
Yeah, and the weather there is first class, isn't it? So.
It wasn't the 27 degrees I had in my head for some reason. I do have a bone to pick with you, though, and I never thought we'd ever have to. I never thought this is something we'd have to worry about, when we just stumbled into podcasts and producing content. But tonight, it might be me today, actually. There was some feedback. We've filmed an interesting episode with you on the Investor Podcast with Owen, our 2 cents last Saturday. Go and have a listen to it, where you could say you debunked the SMSF property story. You copped a bit of vitriol on the old YouTube as a result of that video. I mean, anytime you have an opinion, and anytime you have an opinion on property, you'd know this. You're always opening yourself up to a bit of healthy banter, let's call it.
Yep.
But one thing I didn't see coming, and I think I'm probably at risk today, definitely, is there was one comment that came up that I still can't, feels harsh bring it up, but Gobbledygookity, obviously an anonymous name, said...
Great name.
And I don't agree with this. I loved what you were wearing. It's so nice of you to make James a shirt from your curtains. Now, I think this was so unfair as well. You were wearing a lovely green linen shirt, like an olive green, and the curtains in that office are actually grey, but something with the camera made the curtains and your shirt look incredibly similar colour. This is just, and yeah, I'm happy because you hadn't actually read this yet. You don't pore over your YouTube comments like I do and take it all to heart. And
Yeah, no, I like my mental health. Thank you very much.
Exactly. But I thought this is just, there's a few comments. Can we have the spreadsheet? It's a good segue to that too, but this one just stood out and I was like, I can't let that go. But luckily your background here, I don't think you'd be able to find a shirt that looks like the beautiful painting you have in the background when you're recording from home as well.
Yeah. Well,
thank you for
the comment. Yep. I was inspired by the sound of music and thought it'd be nice to get the drapes and fashion a shirt out of them. So I'll have to have a look at the video. That's a pretty stinging insult, actually. We're
planning on doing an episode.
When I wear that shirt, no matter what I'm doing, I'm going to think, well, it is made of curtains, so maybe I should put it back on the rack.
And I mean, a good segue out of that, I think the quicker we segue out of that, the better, is for those listening now, they've probably seen NVIDIA. So we don't always talk a lot about investments and the detail of investments on the Retirement Podcast, but NVIDIA's charged to a US $4 trillion valuation. It's been, crazy to watch, to be honest. And I think it was only $1 trillion 12 months ago, 18 months ago.
Yes.
And I think I find it important to, like, NVIDIA, no one really knew about this company, I'd say 2 or 3 years ago. Maybe they heard about it when we couldn't get any chips in the, semiconductor chips, not potato chips during the pandemic. But in 2020, you started hearing about NVIDIA because their chips are in everything. They're in cars, they're in iPhones, they're in everything.
Yes.
And then this massive boom in AI has just turned NVIDIA into the biggest company in the world in a very short space of time.
Yeah. Yeah.
I think you use ETFs in your portfolios as well as active funds. Yeah.
Certainly got a good chunk of exposure there. Yeah, it's unbelievable. And my memory of NVIDIA is a little bit different. I'm very familiar with NVIDIA from years and years ago, but that's because for a
You're
little
a gamer,
while,
weren't you?
yeah, look, I wouldn't say I was a gamer per se, but I played video games like every other teenager. And and they just pop up on the screen at the beginning of the video game that you were playing. So that was my familiarity with them. I didn't realize that they were in chip manufacturing until their share price started to rocket. And how's this happening? I thought it might be linked somehow to gaming and COVID, and then realized that, oh no, you guys made a significant pivot quite a few years ago, and it looks like it was a good pivot. Yeah, the NVIDIA are now the largest, like with this recent rise, they are the largest company on the planet in terms of market cap. So the biggest six are all US, and you're looking at NVIDIA at 6 trillion, Microsoft at 5.5 trillion, Apple at 4.8 trillion, Amazon 3.5, Alphabet 3.2. So if you want to get off the US market, you've got Saudi Aramco. They're at 2.5 trillion, and then you've got Taiwan Semiconductors, which is TSMC. They're at 1.9 trillion or 1.8 trillion.
And they're a supplier to NVIDIA as well.
That's right. Yeah. These are big companies, of course. Interestingly, from an earnings perspective, and this has been something to watch too, which is that NVIDIA are climbing up that earnings ladder too. So in the past, one of the big concerns about NVIDIA's valuation was the fact that the multiple is still insane, but the multiple was just absolutely wild. But now the multiple is starting to better reflect the earnings. I think they're currently ranked 6th in the world from an earnings perspective. Coincidentally, highest earnings in the world, 204 billion, is Saudi Aramco. NVIDIA sits 6th with a paltry $90 billion a year. So they've really got to pull their socks up there.
And the growth numbers are exceptional. Like you look at every quarter, they're reporting almost like 100% growth on the same period the prior year. And this is the vast majority of their sales are all going through data centers. So it's the chips are powering data centers, which are then powering the likes of ChatGPT, Claude, all these AI and automation softwares that we're all playing with. Or maybe that's what we should do: use AI to prepare some photos of.
I thought they were playing with us.
I'm always, when it comes to this, I'm always like, why does it matter? Like, why does it matter to a retiree? And this one is more relevant than ever. You need to know why about NVIDIA, because if you're invested in anything, if you're in an industry fund, if you're holding IVV, VGS, any of these popular ETFs or any active fund in global shares at all, you've got a big exposure to NVIDIA. Your retirement, part of your retirement is tied to NVIDIA. It's as much as, I think the last rebalance is like 8% of the S&P 500. So that's like the biggest index in the world, and this is 8% of it. It's massive. It's the CBA of, well, can we say that? It's the CBA. I just want to do that nice segue back to CBA too. It's the CBA of the S&P 500. It's not quite the same weighting, but is the most important company. And if this company, halved, then your returns for your superannuation and your retirement are going to be, significantly impacted as well. So,
yeah. Well said, except for the CBA reference. I mean, NVIDIA's got really well documented earnings growth, and it seems like they've got a trajectory, whereas CBA's earnings growth is hyper limited in a really constrained market. But sure, yeah.
You're making a comeback though. You're 190 down to 180. So, yeah, I'm getting nervous.
Lord. Oh yeah. Well, you've got a little while to go, and as I said, I'd rather just ship you dinner and us not have the market turbulence of CBA falling another 20%. So Yeah, onwards and upwards. Let's move across, if I may. I'm keen to have a chat about our boomer briefing, because we've got some interesting stuff to cover off today. We've had a couple of questions that are quite aligned here. One of them was around the idea of investing in bucket companies. Now, a little beneath that, there was another question from another listener. Thanks again for the questions. That was the idea of how to plan for death with complex entity structures. So I wouldn't mind having a punt at both of these, because I think they tie in pretty well together. Why don't we start with the idea of investing in bucket companies, and contextually, if you're looking at building your wealth for, let's say, accumulators, people that are looking to build their wealth as they move toward retirement, why do people do this, and when does it work?
Yeah, I mean, great question. And this is kind of coming up more and more regularly at the moment. And I think the fact that not that the superannuation cap is going to impact a lot of people immediately, but the fact that the Div 296 cap's being talked about, it's making people think about other entity structures. But ultimately, you've got three main ways you can invest, or you can run a business or hold assets. You can hold them as an individual outside of superannuation. You can hold them in your own name. You can hold them in joint names. You can hold them in a family trust, or you can hold them in a company. All these things are kind of tax controlling or tax delaying mechanisms, as opposed to tax reduction in most cases. You can get a little bit of benefit, but family trusts, we probably talked about those before. The benefit of a family trust, the ability to stream income between beneficiaries. So if one partner is a lower income one year, you can decide who gets what income. But the problem with the family trust is all the income has to be paid out, and the capital gains have to be paid out every year, and the losses get stuck in there or have to be used up. So companies have become more attractive, and it's similar to investment bonds, which I think we'll probably touch on as well. The companies have a fixed tax rate, which is below the highest marginal tax rate. I think it's 27.5% at the moment? Yeah. And it can depend on whether it's an operating
30 for non-trading.
Passive entity, yeah. Yeah, exactly. But companies are basically a locked up structure. So if you're investing in that entity, you pay tax at the company tax rate. And like you would in a normal business, you get the benefit of a franking credit being produced when you pay that tax. So it's a closed entity structure, and you don't have to pay money out of that company until you want to. So it's actually, like any other business, you can pay a fully franked dividend to yourself at some point out of that company, but you don't have to, which means you can shield that money from your marginal tax rate for a period of time. Likely has to come out at some point. And it does open a whole new episode about things like Div 7A loans, but I don't think that's the purpose of this. But essentially, you've got a capped tax rate that you can, if you're on the top marginal tax rate, so if you're earning in the $200,000 a year, you have the ability to cap out your tax rate and end up with a potentially better after-tax outcome. Do you use them very often?
I think you've answered that really well. And to thinking about the bucket company piece in particular, often the people or investors that have bucket companies have often followed a particular path, and the bucket company ends up being the last stop in that path. They might start off, for example, having income in their own names, whether that's self-employed income or investment income. And that income grows to a point where they're now paying really high tax. So most commonly they'd be, let's say, highest marginal tax rate, earning over $190,000 is the current position. And so you look at this and say, this is a lot of tax now. Can we do any better than shipping half of all of our profits here on to the government? So then the next natural step is a family trust, because that's, as you pointed out, going to allow you to perhaps get better opportunities. You might distribute some to your partner or to adult children. And so on. It's going to give you more flexibility to hopefully minimize the impact of your own really high tax rate. But what will happen in a lot of cases is eventually you'll exhaust those avenues to the extent whereby even with the use of a family trust, it's still beneficial because you can get more money out before you hit highest marginal tax rate. But even based on your beneficiaries and the circumstances of those beneficiaries, we still have this big tax problem in that we don't really have anyone to distribute to through the trust without highest marginal tax rate. And as you pointed out, mate, when it comes to the tax that, like the family trust, I mean, you technically can retain earnings in a family trust, but of course the government says, we know what you're doing there. So if you want to retain earnings in a family trust, it's highest marginal tax rate anyway. So you're almost never better off. Some strange circumstances, asset protection, but mostly you're better off just distributing it out and getting that done. So the bucket company sits, I suppose, at the bottom of that, whereby you've said, okay, step number one, I ran out of my own, ran out of my tax rate is really high myself. So then I've gone to a family trust and I'm exhausting avenues to the point where the average tax rate is now still super high.
My children want their tax returns back. Yep.
Yeah, correct. Yeah. So then the bucket company sits at the bottom of all of that, so to speak, and that allows the family trust typically to distribute any extra income that otherwise I've got no one for it to go to without paying a lot of tax. All right, let's distribute that into a company. The company's going to pay tax at, depending on whether or not it trades, we'll call it 30%, but that's still much better than the other tax rates. Now, the advantage is that I paid less tax to get that money out of the trust, which means that I don't pay highest marginal tax rate, so happy days. But there is often a disadvantage, which is that having money invested or stuck in a company can often create inferior outcomes in the sense that you don't get a capital gains discount on the investments. Okay, that's probably the biggest one when you're investing money. But there's a couple of others there whereby ideally you'd rather have the money back out in your own name and doing what you want with it. But in order to get it from the company even back to your name in the future, eventually you've got to pay tax in one way or another. So the bucket company for a pre-retiree can be amazing because if your income is high enough to justify it, it essentially allows you to defer the time that you eventually pay yourself that income until such a time as perhaps you have retired or you've reduced your hours, your marginal tax rates come down a lot, and then you can take the income at that point, right?
Thanks for watching this episode of the Australian Retirement Podcast. I'm Owen Rask, the founder of the Rask Group and Chief Financial Officer of Rask Invest. One of the great things about retirement is you get to switch off your active income and move into a mode where you rely on passive income from your investments. This can be a daunting time for a lot of people. In fact, most people in our community will seek financial advice at this time in their lives. So if you're watching the Australian Retirement Podcast, you should know that we have resources to help you find a qualified and vetted financial advisor. To get in touch with one of our financial advisors or partner advisors, you can head to the YouTube description that's below the video and simply click the link to get taken to a page where you'll find lots of resources for finding a financial planner. We've even created a matching tool which matches you to an advisor that we think may be suitable for your stage of life, your assets, or your goals. And you can also find resources on how to verify financial planners and their qualifications. It's all available in the link in your YouTube description. Let's get back to the show.
Yeah, I think too many people see it as a tax minimization strategy, but it's actually just a tax delaying because ultimately you're going to end up paying if you were to pay it out straight away, you're paying a very similar tax rate that you would be paying. But it is a delaying because at some point you're going to have to declare fully franked dividends. And if you put a lot of money into it, then you're probably paying tax even when you're over 60. You can kind of manage it as much as you can, but you still have to pay it out consistently. And I think so many people forget about it and they go, I'm going to use the cash in there for my personal use, but then it becomes a loan and then that can be deemed a dividend and then you get tax on that anyway. So I think, there's a bit of complexity, but it works as this. If you running a lot of medical professionals have similar structures, a lot of legal professionals, consultants have similar structures, and it is incredibly powerful. And I mean, the way I think you probably share a similar view is when we're helping people invest across multiple entities, we try and find what the best investments are for that entity. So as you said, there's no CGT discount. So we probably want to have assets we can control the capital gains on within that entity, or you want income as opposed to growth assets in that entity where it's possible. So I think it's always considering, the tax tail doesn't have to wag the dog, but you need to be considering the tax impacts when you're building portfolios. And I get one of the big benefits is it sits outside of your will basically.
Well, that's a beautiful segue, mate. Well played, because we're now, let's talk to this second component. We've talked, I guess, about the structuring, the tax elements of it. But you had this wonderful question specifically about the complexity of your estate planning, how to make sure that your money still goes where you want when you've got a lot of entities, when you might have your family trusts and you've got multiple companies. Why is it harder, and what do people do here?
Yeah, it can be super complex, and you're just handing over a problem to your next generation if something goes wrong, because the only way to shut down that company is to sell everything and pay everything out. And that's, if you were trying to do that before you passed away, then it's going to be, it's going to be a lumpy amount of tax. But family trusts and companies are generational entities, basically. So they'll continue family trust for 80 years, I think, and companies in perpetuity almost until they're closed down or until they're shut down. So I think the thing we forget is that control of these entities can pass via your will, as in you can become the trustee of a trust and then control how the investments are made. But those assets themselves don't get paid to your will and then have to be paid out. They just continue as is. And the same for a company. So you might inherit the shares in the bucket company, but that doesn't mean all the investments underneath stay exactly the same. And then you're inheriting that tax. Maybe it's a tax problem, maybe it's a tax benefit, but who knows? And that could be incredibly powerful. It does. I know we don't have an inheritance tax here, but it can be powerful being able to exclude things from a will, particularly as we're seeing more and more challenges. And having these, you can have certainty around the control and passing of assets in probably more certainty than in other cases. But I think what I've noticed, and this is a conversation I was having this week as well, is that you have to engage your beneficiaries on the journey as opposed to just leaving them without them knowing. I think it's so important, I've seen, to have them involved, understand the structure, understand what's happening. Otherwise, everything's going to hit. And a lot of time, having an advisor that supports that can help with the education process. But it can pass a lot of work and stress onto the next generation unexpectedly.
Yeah, couldn't agree more. I think this also speaks to the idea of having a great accountant and a great relationship with an accountant, someone who not only you work well with, but you expect that your beneficiaries, the ultimate beneficiaries of these assets, will similarly work well with. I was chatting with an accountant not too long ago that was talking about someone coming and approaching them to say, hey, we'd like to bring all of our stuff across to a new accountant. And essentially what they were looking for was a younger accountant. And the only reasoning was our accountants served us really well, but they've only got a few more years of work to go. And we want to make sure that handover is as smooth as possible. So we want to build a long-term relationship with someone so that when we're not around anymore, it's much easier for our children and ultimate beneficiaries. That's a really big consideration. Let's move across to today's big question. And we're going to talk about the difference between an investment bond and just investing in a company for kids' education. This happens a bit, right? Especially for people who have got healthy amounts of money, and they might be thinking to themselves that it'd be wonderful for either kids or often grandkids. Say, I'd love to be able to make sure that they're well educated and we've got the means to ensure that. Commonly, people can just use their savings, but there's alternatives, and one of them, of course, is your investment bonds and education bonds, and then the companies are another element. So, what are the big advantages of one versus the other, mate?
Yeah, I think what I've talked about a lot, and historically, if we're helping, 40 or 50-year-olds accumulate wealth, we kind of say, well, just accumulate the wealth yourself and then pay it to your children later on. And I think it works for some people. I think it's the same with a lot of things. It's like there's questions about offset accounts that come up all the time. And some people, I think that's a big topic in financial advice too, is that some people hate offset accounts because a lot of people see the cash and want to spend it. And I think that's the same idea as having an investment bond. So investment bonds are essentially you're paying the same tax rate as you are in a company. And so you could perceivably just invest the money in a company and then pay it out to your children as a fully franked dividend or something like that once they're an adult to help pay for their education in the future. But investment bonds have this significant kind of benefit, which is the fact that if they're invested and they're serviced appropriately for 10 years, then they essentially become tax paid. And the problem with investing solely in a company is that someone's going to have to pay tax when you pay that money out of the company, whereas the exemption, the loophole, the legislation around investment bonds means that no such event occurs at the end. So as long as you meet that requirement, it comes out tax-free and you can move on. I think that's one of the biggest and most unique differences. And ultimately, as we talked about, investment bonds are becoming popular as a Div 296 alternative. But again, exactly the same premise. You've basically got this closed cap tax entity structure that means you're not adding more and more money into your top marginal tax rate, for obviously more valuable for those in the top marginal tax rate band.
Yeah, I agree. You've answered that well. The only thing that I can throw in here is also the estate planning benefits from a bond perspective, which is, as we've pointed out, if you are to pass, then, and let's say, imagine you've set up a company for with money to go to your kids, not necessarily for education purposes, but just full stop. If the solution was to set up a company, then the benefit of an investment bond or an education bond is that technically it is framed around a life insurance policy, and you are the life insured. And what that means is that if you were to pass, then your beneficiaries receive that benefit tax-free, regardless of whether or not it's in the first year or the 5th year or the 10th year or the 20th year. So also gives a little bit an advantage, hopefully around, to see your children or grandchildren be able to go through their education and see the benefits of that. But if you were not to, there's a meaningful tax benefit if you're not around.
Yeah, and I think it's significantly more flexible than it used to be. Like, there used to be very few investment options, and investment bonds have opened up a lot more investment options. You can get a lot of index options. You can have a lot more choice than before. And I found also super interesting was that the structure, we talk about the tax rate being 27.5%. All the benefit of these structures is, in a lot of the time, they're actually able to reduce the effective tax rate by, using the franking credits that they're producing within their life company, because they're life companies, to bring a tax rate down to sometimes below 20% in some cases. So I found that's, I don't know how published and how well marketed it is, but it is another benefit. Particularly, again, I find this kind of a niche use of investment bonds. It's not something that is suitable for every single person.
Yeah, I think you've said that well. Listen, I'm just easy, man. I'm just complimenting you the whole time. Buddy. You can get in this easy today.
Yeah, I think it started with me, commenting on your shirt, and then you.
Yeah, I know. Yeah, I think that's rattled me, mate. I've lost the plot today. All right, let's fire one more out. This comes from Wannabe Whale. Don't we all? Question is, hi, Drew and James. Great podcast. Gracias. I would appreciate if you would run through the pros and cons of using an offset account against our principal place of residence to have as a cash buffer and as an emergency fund in retirement. I just think having 3 years of income basically sitting on the sidelines is a lot of cash. We are currently mortgage free. We are still working and plan on retiring in the next 2 years. If it was a split loan, which I think what he means, or what this person means, is if I was to take out a loan against the property and then leave it fully offset, would it be feasible to have half of it on standby as an investment loan for possible investment when the market drops?
I think, and then there's a couple of questions here. I mean, I could touch on the offset thing again. I'm pro offset accounts. So offset accounts basically sit against your loan, and they reduce the capital there reduces the interest that you charged on your loan. They're good as long as you have control and you don't feel that if you have money in the bank you need to spend it. And I know there's lots of different personalities when it comes to spending money. So I think that's it can be incredibly powerful. And something we talk about a lot with our clients is that once you retire, you're probably never going to get a traditional mortgage again. If you need to borrow money once you've entered retirement, you're probably going to have to go to outside of the major banks, and you're probably going to be paying higher interest rates. So we'll always suggest keeping a mortgage open against a house for as long as possible, as a very broad, not as a specific recommendation, but very broad. So I don't see. The only thing I'd say here is that you're having the cash buffer is the offset against the loan, which I think is fine in the lead up to retirement, but perhaps once you get to retirement, you want to think about something different. You probably want the loan offset because there's no point paying any interest whatsoever. And then you want to, in excess of that, could still be held in the same account. There's no reason your offset can't be more than what's in your loan, but having then allocated a portion towards that, because technically you want to be using that to pay off to have the loan completely covered before you're calling that your emergency cash as well, because there's your loan could be, not that we can have loans closed, but you could lose access to it, or the intention of that is to be debt free or non-deductible debt free in retirement.
It's interesting you talk about offset accounts. I agree with the philosophy, or the way that you talk about them. I agree with the philosophy that having the access to capital is really valuable, and especially if you've got good discipline. So often if we're dealing with a pre-retiree similarly that we might want more cash flow flexibility in the future, or just value that, then you set up you have your loan fully offset, however much is left. But instead of paying off the loan, you just ensure that all of the repayments are coming out of the offset account. And then that should result in the loan falling in lockstep with the offset account, so that the balances, you don't end up with that scenario where you've got for example, a $200,000 loan and $300,000 in offset, because that's the bank's dream. They're earning an extra $100,000, or there's $100,000 in this basically interest-free account that they're not giving you any benefit for. So as long as you manage it well, yes. I must confess, though, quite recently, I was leaning into that offset versus redraw debate. And it was pushed to me by a financial advisor I regard pretty well, talking about fundamentally why offset accounts exist. There's the redraw feature was a thing before offset accounts were a thing, i.e. you could overpay your home loan and then you could take the money back out. And the banks realized that giving people access to their money again would mean that they would use it. And then therefore the loan size wouldn't get paid down as quickly. And that was in the bank's best interest. And you could put this under the wonderful umbrella of saying this gives you more flexibility with your life and your circumstances. Not entirely sure it's a better thing to have, mind you. And so that was the original product. And that product is still, that's the standard thing for most Australians, indeed a lot of people all over the world. And then this new product was designed called an offset account. And the thinking for the offset account was frankly just as underhand, which is we've realized that when people pay off their loan, in their own mind's eye, that debt is cleared. And so taking the money out feels like borrowing back on the loan. And so people don't tend to do it. So what we'll do instead is we will have a bank account which effectively allows the equivalent benefit from a pure cash perspective. You pay interest on a lower amount because the loan size is that you're paying interest on is the loan size minus the offset balance. But this will be people's day-to-day cash, and they'll have no concerns at all about taking it out because they will perceive this to be their money versus the bank's money. And I've known about that for quite a while, but it was written in a really, this message was put forward in a really firm way. And I was reflecting on my own financial behaviors and asking myself, as someone who has an offset account and who puts money into an offset account as the vehicle to pay off my own home loan, and I do that based on the internal belief that, no, I've got very good discipline with my finances. We run a tight ship here. Like if anyone can do it, I should be well equipped to do it without too much true penalty. Aren't they dangerous things to say? And I was reflecting on my financial behaviors and thinking about my transactions. And I concluded that actually, if my money was in redraw instead of offset, I think there's a few expenses that I would not have incurred otherwise. Or I would have had, indirectly would have had more financial discipline in other areas.
You felt wealthy, like the new bike, the new titanium bike or something that you got.
Yeah. Well,
carbon fiber, not titanium.
Yeah. Well, it's definitely carbon. Yeah, mate. Come on, get with the times. But yes, it's this is a real thing, and I think it requires a lot of reflection for people as to whether or not their behaviors are actually aligned to having an offset account versus a redraw facility, because that process made me realize that for myself as an individual, there are a number of little areas whereby I'm freely using cash that I don't think I would use as freely if I knew that I had to rip it out, and that meant a high home loan with using a redraw facility. Now, you can look at that and say, yeah, but if you were going to incur the expenses anyway, then it might have all worked out in the wash. But I don't believe that that is true, because I think that if you have, hypothetically, let's imagine that your view is that the money in redraw is not my money, I've paid off the loan and I don't want to touch that ever. That's going to result in you having a lower offset account. And we know, or lower savings, to say it differently, lower available funds. And we know that people's behavior changes when they have more money in the bank. That's been proven time and time and time again. That's a fundamental thing that occurs for every human being. It's behavioral psychology, and it would be very, very difficult for you to avoid that. So this can, the lesson here, please, this can happen to everyone. I think it happens to financial advisors and mortgage brokers and behavioral psychologists alike. If you're not really dialed into this, you can, without realizing, be costing yourself a lot of money by taking the preference of the offset versus having the discipline of clearing the debt.
Yeah, for sure. And it's so, like, I think any good advisor or anyone, a good accountant, good mortgage broker should walk you through that process and try to help determined. Like just because I think it works for me or you think it works for you doesn't mean it works for everyone, and it can result in incredibly bad outcomes if it's not set up right for the right person.
And also, just because you think it works for you doesn't mean it actually does work for you.
Yeah, exactly.
Good show, mate. Good session.
Fantastic.
Thank you very much for a wonderful rundown, and I'm going to go straight back to my wardrobe now and stare at that olive green shirt for a few moments and just decide whether that needs to continue as a rotation in my wardrobe or something else needs to happen.
Bring it back. Just go look at my YouTube comments and then you'll feel better. It's fine.
To all the listeners, thank you again. It is a real honor to have the opportunity to talk finance with you guys every week. Now, I would also kind reminder, please, that we want your questions. We really want this to be as relevant as possible. We care deeply about you guys making as much financial progress as you can. So please don't be afraid to reach out. If you've got any questions, we would love to answer them for you. Please do not forget that we have a wonderful resource. If you log in to Rask, if you go to the community, then there's a whole heap of Australians just like you that are trying to get better outcomes and make more progress with their finances. So between those two, go nuts. And we look forward to chatting to you next Thursday.
Amazing. Good to see you, mate.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.